Good morning, everybody. John King. Appreciate you all being here for my weekly update webinar. Allow me to take a quick moment and introduce Jeff Lee, who is our special guest every week in letting us know if there's any updates in the title and escrow world. Jeff, I'll be a little different today and let you go first. Do you have anything to update us on in the title and escrow world?
Unfortunately not. I almost wish that the title stuff changed as much as the lending industry.
Yeah, lucky you. You get to have a little bit of stability in your business, so good job on that end of the world. I appreciate that, Jeff, and I appreciate you continuing to be here to update us on anything that might come up that we need to know about. So thank you, thank you, thank you. All right, so let's dive in to what's going on in the world today. So out of order, we already did the title and escrow update. We're now going to do the mortgage update. Again, this is similar to the presentation I did on Monday. I always add a little bit because things change just in 48 hours, but it's basically a very, very similar presentation. I always start out with a quick update on the market. We're continuing to stay pretty stable in interest rates. That's super, super good. The problem is, actually, hold on. Am I out of order? No, I'm not out of order. Cool. All right. So we're staying super good on interest rates, and there's actually an opportunity for rates to get better going forward from here. And I want to share with you kind of what that looks like here. So this is a somewhat convoluted chart, and I very simply want to point out how mortgages are sold. They're grouped together into investments that are sold on the bond market, and they're grouped based on the average earnings of interest that the investor is earning on all of those loans. So what you see across the top here is mortgage-backed securities with an average earnings of 3.5%, an average earnings of 3%, an average earnings of 2.5%, and an average earnings of 2%. Don't misunderstand this as the rate that your clients are paying. This is what we call the secondary market, and I'll show you in a second a little more information about the secondary market and what that means. But what you're seeing here is essentially a 2.5% rate that the secondary market earns is typically a rate to a client that is between 2.75 and 3.25%. A 3% rate on the secondary market is a rate to a client of about 3.25 to 3.75 is what gets pulled together and put into that particular bond, that particular grouping. What I need you to understand here is the importance of the fact that there is a brand new bond that has started trading, and it's this one right here that is the 2% mortgage-backed securities bond. This bond started being traded early in April, and this is how many trades. This chart shows how much activity there is. It's kind of like if somebody lists something for sale on eBay. Just because you listed it for sale, if nobody's buying it, then it's not really a normally sold product or a highly sold product. What we're seeing is the 2% coupon has traded more often towards the end of April than the 3.5% coupon. All that really means is that there are normally 3 heavily traded coupons, the average, the low end, and the high end, and it looks like that's shifting down by 0.5%. That the average coupon is going to become the 2.5, the low end will be the 2, and the high end will be 3. Here's why that matters. Rates really cannot go lower than 2.75% unless there's a coupon lower than 2.5. So what just happened in the last month opens the door, does not guarantee we're walking through the door, but it opens the door to the fact that rates now could go as low as 2.25 on a 30-year fixed mortgage, because 2.25% interest rates can go into a 2% coupon. That's huge because only twice ever has the 2% coupon started trading, once in 2011 and once in 2016, and both times it traded for a couple of weeks and then it stopped. And it never got to this level of activity. So there's a lot of reason to believe that the door has been open for interest rates to shift lower. Again, they haven't shifted lower yet. It doesn't mean they're going to, and there's a huge disconnect still between the interest rate that we are charging consumers and what our cost of money, or the interest rate that Wall Street is charging us. But before I get into the specifics of that part, I want to talk about what Wall Street's worried about. And a big part of what they're concerned about is what's called single month mortality. They're worried about what's called prepayment. how quickly is a mortgage paid off? The truth is Wall Street invests in mortgages to try and earn a long-term return on investment. And if a loan pays off sooner than they predicted it would pay off, then they're losing more money because they wrote a big check up front to buy that mortgage. They wrote a check to say, hey, I'll pay you X amount of dollars up front, Summit Funding, for giving us this mortgage. And over time, we're going to earn that money back in interest. But if that mortgage pays off quicker than they expected, they're not making back their money. The single month mortality rate of mortgages spiked in March of 2020. So you see here now, it had been higher back in 2012. So again, you got 20, this is going back to 2008. So 2008, 10, 12, 14, 16, 18, and 20. But we are back above levels we've seen in 2015 and 16, and we're almost to levels we saw between 2012 and 2013. That is a piece of the puzzle that will continue to keep rates higher than they should be, because investors have to make up for their losses on their current book of business by charging higher returns on their future book of business. As well, they're concerned that if they lower rates too much, it's going to increase this prepayment even faster. It's a double-edged sword, and it has a lot to do with what I said last week when I told everybody, guys, plan on your clients having to pay for risk by paying an upfront fee instead of paying for it in a bump in interest rate. If you missed last week's webinar, it's on YouTube, check it out. I spent a lot of time talking about what that means and how someone buying an investment property, somebody buying with low credit scores, they're more likely to pay more in fee than to pay more in rate, because the investor is not willing to bump the interest rate higher to make up for risk, because the higher the rate, the more likely somebody's going to refinance in the future, given how low we think rates are going to stay. All right, so Judy asked a question, guys. As a reminder, if you have any questions, feel free to post them in the Zoom chat. I will absolutely answer them either as they come up, I'll answer it, or I'll postpone it if I think it's something I'm going to get to. So Judy asks, how long will it last that investor payback recoup on prepayment? There is no time frame on it, Judy. It's a mixture of factors that are causing rates to stay high, and that's one of the challenges that investors are dealing with. It is kind of like if you say, how long will it last that buyers are, concerned about going out and looking at homes when they're concerned about the COVID issues and they're not sure if they want to go out into homes, or sellers don't want people in their homes. There isn't an exact time frame you can put on that, because there's a lot of other factors that, let's say interest rates dropped a whole lot. Well, then that buyer who wasn't willing to go out and look at homes because they're afraid of being out in public might be extremely willing to go out and look at homes because rates fell down to 1.5%, and now they absolutely want to buy a house because they can get such a screaming deal on a house that the risk of getting sick is not as big as the benefit of getting a new house at a 1.5% interest rate. So there's other factors that come into play that people, you can't isolate any of these factors into a vacuum and say, well, this factor is going to go away over a certain period of time. It's just one of the reasons why the industry is so broken. And I'll dive in a little deeper into what broken means with this chart. So I'm using more charts today than I normally do, but I found some cool charts that demonstrate a lot of the things I've been trying to show you guys. And this one talks about what's called primary versus secondary rates. So the primary markets is what we as mortgage banks charge your buyers or people, homeowners that are refinancing, what rate they're paying. This goes back to January of this year. So in January of 2020, the average rate for a mortgage was around 4%, and it stayed that way through mid-January, and it started falling, and by February 1st, it was around 3.75, and it goes up and it goes down. And we fell below 3.75 right at the end of February, and by early March, around March 9th, we hit the absolute lowest interest rate we'd ever hit right here, and it spiked up. And it has never gotten as low as it was back on March 9th. So I continue to show you guys that first chart we saw today that I show you week after week, that I keep saying March 9th was our best day of rates and we've never gotten there again. And this shows that we've never hit this level. Even as of today, we're not as good as where we were on March 9th. But this chart, this line right here, this is the line of what our cost of goods are, what our cost of money is. So think about if you are a retail store and you're selling whatever, you're selling widgets, and you sell your widgets for 10 bucks a piece and they cost you $3. Well, if the price of the widget when you buy it goes from $3 to $1.50, then you could theoretically lower the price of your widget from $10 to $5. And what we're showing here is normally as our cost of funds goes down, so does our interest rate. And as the cost of funds went down, our interest rate went down. And this third line is simply the difference between these two lines. So you can see this stays pretty stable. There's almost a 1.5% difference between what we have to pay for loans and what we're charging the consumer. And that's been pretty steady all year, that it's about a 1.5% difference. And then it dropped really quick right here where we had, hey, the cost of money went up, but our interest rate stayed low. And in middle of March, we saw these two numbers flip. We saw our cost of money, the Federal Reserve stepped in and started buying mortgages, and they lowered the cost we have to pay from somewhere around 2.5% on average to maybe 2% is what we're paying, to now our cost our cost on the secondary market has dropped to around 1.5%. So we've saved almost 1% off of what our cost of funds are, but we've only dropped by about 0.5% in mortgage rates. That's a better demonstration of what I've been trying to explain, where our difference between the rate we're charging and the rate of our cost has grown significantly. That's part of what Judy, I talked about with that investor payback recoup thing. It's not as simple as I explained it, but I'm trying to take complicated concepts and break them up into simple pieces. But all of those pieces come together, including forbearance and the challenges of banks having to shoulder the majority of the cost of loans going into forbearance, that the banks are having to keep additional profit in their hand, so that then it's not profit, but revenue. They're going to have to keep additional income because they know they're going to have greater future expenses to cover the cost of loans going into forbearance. That's why this spread has increased. Again, if you have questions about this or anything else, feel free to post it into the group chat, and I'm going to continue to move on. I'm having fun with charts today. Guys, this one, I'm not going to go deep into. It's kind of just an interesting way to look at the market, and what this is comparing is the 10-year Treasury rate. So the 10-year Treasury had been back at in early March, was at over 1.5%. And it fell very, very quickly, and it fell down to like 0.35% literally in a 1-month time frame. So the 10-year Treasuries fell by 1%, and part of that is the stock market. And you see that when the stock market goes bad, that's good news for interest rates, and normally they move in the same direction. So bad news for the stock market is a drop in interest rates, which is good news for interest rates. But we had some major disconnects that happened there, where the interest rate spiked way up while the stock market was still dropping. So you got to be careful when people say, oh my gosh, we should pay attention to, good news for the stock markets, bad news for interest rates, and vice versa. That isn't always true, especially when the markets start to get wonky. And when I say wonky, in this case, we're talking about the fact that there was a lot of scarce fear. There's a lot of fear in the market until the Fed stepped in and started buying mortgage bonds. Right here, this white line is where the Fed says, hey, we're going to announce emergency measures. And this white line, a week later, is when they said, all right, our first announcement didn't work enough. We need to put all of our effort towards this. And that brought the stock market back up and Treasury rates down, so that now they're pretty close to one another. But normally there's a bit more distance between the two. So we expect something to happen. It's kind of the calm before the storm. And for the last month, it's been a little bit too calm. So expect a storm. And I don't mean to say that in a fearful way, but just we understand the markets move a lot. And there's been too little movement over the last month. And there's a lot of wild cards out there that are going to create uncertainty on where the market is going to go from a stock market perspective. What I can tell you is the Federal Reserve is firmly committed to keeping mortgage rates low. So I'm really not worried about mortgage rates going up. As I've continued to tell you guys over and over again, I don't have a concern about rates going up. The concern is obviously the economy in general and where the stock market's going to go, and those are ancillary concerns, but I'm not concerned about the interest rate market in the near future, and really between now and the end of the year, I'm not really concerned about interest rates going up at all. All right, I'm going to move on to my favorite topic of forbearance and give you guys a quick update on some things. So first of all, what you'll see in this chart is the number of people filing for forbearance per day. And it was really super high at the beginning of April. And then it went down a little bit and it stayed pretty high. So the first half of April had huge forbearance numbers. And if you've been following my videos every week and attending this webinar, you know that over the last couple of weeks, I said we're worried about homeowners procrastinating and not filing forbearance until right before their 30-day late it comes up on April 30th. But what we found is those numbers stayed super low for the second half of April. The question is that going to repeat itself in May? Because there are people that made their April 1st payment on April 1st or 2nd. Like, there are people who actually do that, and then they lost their job sometime in April. So they didn't necessarily file forbearance yet. Maybe they're hoping they're going to get their job back. Maybe I don't know what the scenarios might be, but there's a lot of concern about whether we're going to see a huge spike in forbearance requests again the first week of May. So that's something we have to pay really close attention to, but this just kind of gives you an indication that the good news is the number of forbearance filings per day has slowed down. The question is, where's it going to go? And everybody's got a model and everybody has statistics. And I've actually told you guys before, 79.2% of statistics are made up, including that one that I just told you. So the fact is, you got to take everything with a grain of salt. This is very simply projecting forward and saying, hey, worst case scenario versus best case scenario. Right now, we're at about 3.5, almost 4 million people in forbearance. Our worst case scenario by the end of June has us over 9 million people, more than double the number of homeowners in forbearance. And Fannie Mae came out last week saying that they've increased their estimate of people that are going, of Fannie Mae's customers that are going to go into forbearance from 9% to 15%. So they're currently at 9%. They're expecting 15% of their homeowners to ultimately be in forbearance. So the question is, where does it go? And unfortunately, this is a huge spread. It's anywhere from 4.5 million to 9 million just over the next 2 months, depending upon how this plays out. So there's a lot of uncertainty still in where the forbearance numbers are going to end up, because unfortunately, we continue to see unemployment filings happening on a weekly basis. And if you think about it, if you lost your job, I don't know about you, but the first phone call I'm making is to file for unemployment. And then the second phone call I'm making might be to my mortgage company to say, hey, can I get a forbearance? So if we had constant weekly increases, not increases week over week, but continually every week for the last month, we've had a significant number of people filing for their first-time unemployment claims. That means that there were a lot of people who didn't just lose their job in March, but lost their job in April and mid-April. Some companies said, hey, let's postpone for a month as of March, whatever it was, March 19th, when most of the country shut down. And a lot of companies said, let's hang tight for a month. Let's put our employees on a special payment plan. Let's keep paying their salaries, whatever. Disney did that for a while. And so we're going to pay all of our employees for the next month. But at a certain point in time, they realized we're not opening up anytime soon, and they had to lay people off. It is our concern as we continue to go forward on how many people are going to continue filing for forbearance. And so I want to cover a couple of miscellaneous things about forbearance. First of all, I already mentioned this, April ended much softer than we expected. The question is May going to start out with a high number or not? We'll know in the week or two to come, because these numbers are lagging, typically a week or more. 7.3% of all mortgages are in forbearance as of April 30th. That's a pretty significant number, and it's well over 10% for government loans. When I say government, I'm referring to FHA and VA loans. This third bullet point, I want to take a couple minutes to really dive into these last two bullet points here. I want you guys to help me spread the word, or at least combat the challenge that comes from taking call center advice. We, unfortunately, as an industry, told clients to go talk to their servicer. Pick up the phone and call your servicer and ask your servicer what it's going to mean when they file for forbearance. And that is the right person to call to ask for that servicer's policies. The problem is I'm hearing back from a lot of clients who have said, hey, my servicer told me that there's no impact to my credit at all for me to do this forbearance. So I'm going to go ahead and do it because it's not going to hurt me at all. And when I said, hey, John, hey, you know, I know this is going to impact your ability to refinance down the road. I know it's going to impact your ability to purchase a home down the road. And a couple of clients have been adamant about saying, John, I think you're wrong. Like you're saying that it's going to impact me, but the bank said it's not. And the advice they're getting is from a call center phone jockey who's reading from a script. And the script was written to teach them how to talk to consumers legally about what the CARES Act says. They're not giving advice. They're not talking about the bigger picture. It is 100% correct that it will have no impact to your credit. But as a mortgage company, we can look at things outside of your credit to deny you a loan. And the fact that you didn't make your mortgage payment may not impact your credit, but it's just like if you have a private mortgage with a private party, and that private party does not report your mortgage payment to the credit report. So if you're late on that mortgage payment, it doesn't impact your credit. But we absolutely have to look to see if you made the payment on time, and if you missed a payment to that private mortgage holder, we have the right and we will deny your ability to get a mortgage. It's exactly the same scenario. We don't have to only look at the things that impact your credit. As the lender of the money, Fannie Mae, Freddie Mac, FHA, and VA have the right to say, we're going to look at things beyond just things that impact your credit score. So don't let your client fall victim to that call center advice that says, don't worry, it's not going to hurt you, because it is going to hurt you. And as a matter of fact, I've got something I'm going to add at the end here that is a little bit scarier when it comes to some of the SBA disaster loans, because there's some unintended consequences that, you know, you can go back to my recordings 4 and 6 weeks ago. I told you guys, go get those loans. You need to be in a defensive position and get money. Well, I'm now realizing that that advice didn't have, I was lacking some knowledge that I now have that says there are some unintended consequences to taking out those loans, and I'll cover that in a little bit. But be careful, even the advice you get from me, because we can only give advice to what we can see today. And if we can't see it today, we can't plan for it, but there are things that are going to impact us we weren't expecting. The second thing I'll tell you is the last part of this, the last bullet point here, the modification tidal wave. I am super concerned about what this is going to look like once the forbearance period is over, because that's when the problems are going to arise for people who filed for forbearance that did not have a financial hardship. And they were told by their banker, they were told by you know, somebody on TV that, hey, you know, make sure that you're, just like what I told everybody about, hey, go get the SBA loan, there's nothing negative about it, and make sure you have some extra cash in hand. Well, they were told by somebody, hey, go do a forbearance on your home because it's not going to hurt your credit and you'll be in a better position going forward by having extra cash in hand just in case. It is becoming clear, we don't have clear guidance, but it's becoming clear that when your forbearance period is over, you will be asked to prove that you had a hardship, or you will be required to pay back the entire amount of the forbearance in one payment. So this is providing more clarification to the commentary I've made over the last couple of weeks, where originally we said, hey gang, you got to be careful, everybody's going to be due to have to pay that payment in one payment. And if you're forbearing for 3 months, that means on the 4th month, you owe all 4 payments. If you're forbearing for 12 months, then on the 13th month, you owe all 13 payments. Well, then Fannie Mae and Freddie Mac came out and said, nobody is going to be required to pay back the forbearance all at once. A balloon payment will not be required. And that's an accurate statement. But the challenge is, if you did not have a hardship, you're not going to be granted a modification. That's what we're hearing right now, because a modification is need-based. And if you did not have a drop in income, when you apply for a modification, because that's what's necessary in order to not have to repay the forbearance payments all at once, we're inclined to believe right now that modification will be denied. I don't know what's going to happen to that homeowner. I don't know if at that point the federal government is going to say, okay, hey, you didn't make your payments, you're behind, pay it all in full, or we're going to foreclose on you. I don't know if that's going to happen. I'm not purporting that will, but what I'm telling you is it's becoming super, super clear that the people that had a hardship, everybody's going to do everything they possibly can to help them work it out. The people who didn't have a hardship, they're going to be in a very, very tough position, likely be requested and or required to make that full balloon payment when the forbearance period is over. The unknown is what happens if they can't make that extra payment. Well, at that point, then they kind of have a hardship, but it's a self-inflicted wound. And will they give help to those people? Push comes to shove, I think the answer is yes. What that help is going to look like and how badly it's going to bury their credit score and impact their credit negatively is what I'm also concerned about. All right, any questions about that? Again, a lot of things I covered, especially about the call center advice and the modification tidal wave and needing to prove hardship. If you have questions, feel free to post it into group chat. Otherwise, I'm going to spend a good amount of the rest of this meeting talking about what the future looks like for mortgages coming out of the shelter in place. The first thing I'll tell you is Fannie and Freddie are working on new rules for borrowing after a forbearance, and we expect to release this week or next. The questions we're hoping to have answered are questions about, hey, once somebody goes into forbearance, how is that going to be treated on the credit report? Are we going to treat it like we treat a mortgage late payment that says you can't have any mortgage late payments in the last 12 months? Are we going to treat it as a bankruptcy that says, hey, it's got to be 3 years since a bankruptcy? Or are we going to treat it like a foreclosure that says it's got to be 7 years since a foreclosure? I don't think it's going to be that long of a time frame. I think it's likely to become a 1-year wait period after you start making your payments and you have a year's worth of consecutive on-time payments before you can do a refinance or purchase a new home. That's my gut impression. But we're going to get better guidance on that, hopefully in the next couple of weeks from Fannie Mae and Freddie Mac. But the questions that we need more answers to have to do with people who didn't file forbearance, because that's a whole separate question. But it's a few examples of what I want to talk about here, and I've got a few slides to talk about different pieces of this. But the first one has to do with income calculations. How are we going to treat a wage earner that, hey, you work making $20 an hour and you work 40 hours a week and your company was closed for 2 months and you were on unemployment? The first thing Fannie Mae and Freddie Mac just confirmed, which I already knew to be true, but they reiterated, was you cannot use unemployment income and you cannot use, you cannot qualify someone who is on unemployment unless it is seasonal unemployment. It's always been a confusing issue, but we have always been able to count unemployment income if it is recurring seasonal unemployment, and we can close a loan for someone while they are unemployed if it is seasonal recurring unemployment. I have a client right now that I just closed escrow on that is not working, and they have not worked since last October, but it's because they're a farm worker and they spend the winter time earning unemployment. They have not yet started back to work. Now, there was a bit of a question in the minds of the underwriter about, hey, are they not back to work yet because of COVID? Or are they not back to work yet because of the farm season has not started? Fortunately, we were able to prove that the season didn't start last year until mid-May. And we closed in early May. Now, I have no clue if they're really going to be back to work in mid-May. And if they aren't back to work in mid-May, and we were closing that escrow in June, we might be in trouble because now the underwriter is assuming, hey, wait a second, now the lack of income's COVID related, not seasonal unemployment related. So the question really comes back to how do we treat those people who have a steady job, work 40 hours a week every week for the last 10 years, but they were off for 2 months because the company was shut down? I think that's going to be the easiest of all the questions I'm posing here, because I think we're simply going to say, yeah, they always work 40 hours a week. So we're just going to ignore the fact that they were off for 2 months, and we're going to count their 40 hours a week at $20 an hour. The harder question comes with the person who made commission, bonus, or overtime income. Because normally what we do is we look at the last 2 years of those types of earnings, and as long as it's stable or increasing, we use that average. But I know a guy who is a salesperson for a moving company. He is a necessary business. He is out there, he is working, but he's not making any commission. He gets paid $15 an hour plus commission, and he's made an average, decent, good commission amount every single month since he's been doing this for the last few years. But right now, he's not making any commission. I cannot use his commission income right now because he's not earning it. But what about in July? What if his income goes back up in July, but he had March, April, May, and June that he had no commission earnings? How do I treat that? Technically, under normal circumstances, I'd say, well, this year's a low trend. I have to count this year's average, which would be next to nothing. We're waiting for guidance from Fannie Mae on how we treat that person who has variable earnings. Do we count the months that they were off? How about if they weren't off, but they were underemployed, like my guy who works for the moving company? It kind of would be easier if he had been laid off for that time frame, because then my future calculation could clearly ignore those months that he was laid off and say, well, he wasn't working during that time. He couldn't have earned commission, but technically he was working. Technically he could have earned commission. And so is his lack of commission earnings in those months that were affected by COVID going to be ignored in our future calculation or not? Let's take it one step further. Is moving going to come back as quickly as what it had been a year ago? I don't know. Maybe that's a bad example of an industry. Maybe a better example of an industry is someone who works in some kind of hair or beauty, people who do nails and salon type of stuff. Is their business going to come back as quickly as it had been? Is the guy who owns a movie theater, is his business going to come back as quickly as it had been? Or the waiter or waitress who earns tips, and we can see their average of tips over the last 5 years has been super, super good. But how about the waiter at Ruth's Chris? Okay, high-end restaurant. Nobody's going to go there anymore because they got PPP money. I'm totally kidding. But you've got the waiter at Ruth's Chris who makes a significant amount of income off of tips. Do I, because they've been closed for the last couple of months, once they're back up and running, do I use his tips from 2019? But can I reasonably assume his tips from 2019 are going to reflect the tips in 2021? Or do we all have some concern that, hey, the world's not going back to the way it used to be for quite some time, and his ability to pay a mortgage for the next year or two, while we still practice some form of social distancing and you have fewer clients, fewer patrons at a restaurant, are his tips going to be as high as they used to be? Those are all questions that our prior modeling has gone out the window. We can't predict what's going to happen, and banks are going to be super interested in hearing how Fannie Mae and Freddie Mac want us to treat this. That's a big component of this. The same holds true for self-employment, and I covered a lot of those thoughts just now in scenarios that apply to self-employed people. Is the dry cleaners business going to come back as quickly as it used to? How about the guy who's a commercial landlord? You've got people that now are going to start working from home more instead of maybe working from the office. So is commercial real estate going to slow down some? And can we assume their income's going to go back to where it was in 2019? Is that reasonable or is that unreasonable? These are all questions that are going to create issues, but I will tell you that it's not going to be business as usual. There are going to be challenges with how we qualify people going forward, especially when they have variable income, and are we willing to count that variable income or not? Huge questions there. There's also a lot of overlays that are coming into play that vary from bank to bank. So I'm going to go over some of those things that are happening already. We're going to see more and more of this going forward. So these vary by institution. There is no one company I'm outlining here, but I'll tell you that self-employed people, an example of what some companies are doing is requiring 12 months of payments in reserves if you're self-employed. So think about that right now. If you were buying or refinancing a home and you've got a $2,000 a month mortgage payment, they're requiring you to have $24,000 in reserves in order to count your income and qualify you for a mortgage. If you as a realtor don't have $24,000 in reserves because you're self-employed, that company says, okay, fine. Then I'll take last year's income and shave it by 25%. I'll only let you count 75% of your income from last year, and you still have to have 6 months in reserves. So you've got to qualify on 75% of your income and have $12,000 in the bank, or you don't qualify for a mortgage. These are the ways that some companies are coming up with ways to say, hey, maybe the income's not going to be as good as what it was in the past, but they have a lot of money to carry themselves through. Or if they don't have a lot of money to carry themselves through, we're going to cut back the income and they still have enough earnings and some money to carry themselves through. We should be in good shape. On people who are wage earners, this is actually a Fannie Mae Freddie Mac rule. They're requiring pay stubs to be no less than 60 days old instead of no less than 120 days old. Minor change, but a big change in the age of documentation that says hires way more often by updating their paperwork a lot more often than we used to. Same with bank statements. They have to be within 60 days of closing instead of 120 days of closing. Cash out is a major, major issue. You guys heard me talk about this last week and the week before. Here's some examples of, and again, and banks are worried about cash out because Fannie Mae and Freddie Mac said if a purchase or refinance without cash out home borrower goes into forbearance before before the loan is sold to Fannie Mae or Freddie Mac, Fannie and Freddie will buy it from us, but they're going to charge us 5 to 7% of the face value of the mortgage as a penalty fee. But it's even worse on cash out, because on cash out, they're saying, we're not going to buy them at all. So if we do a cash out refinance and somebody goes into forbearance between the day we close the loan and the day we sell it to Fannie or Freddie, we're stuck eating the entire face value of that mortgage. That means that some banks are saying, hey, we're going to limit your debt to income ratio to 36% of your income can be going towards your debts when you're pulling cash out. Because the lower your debt to income ratio, the less we have concern about you filing forbearance. Now, Summit does not have this overlay, so we'll go up to 50% still. Some banks are saying you got to have a 720 credit score or better to pull cash out. We don't have that overlay. Some banks are saying you can only borrow up to 70% of the value of your home when you pull cash out. Again, we don't have that requirement. We'll go up to 80% still. Some banks, including Summit, are saying we will not do cash out on second homes. We will not do cash out on investment properties, and we will not do cash out on 2 to 4 unit properties. My company has these requirements. We feel like that just adds an enhanced level of risk that we're not willing to take the chance of losing the face value of the mortgage by somebody going into forbearance. Yeah, we hope these programs will come back in a few months. When the forbearance issue is over with, then we don't have to worry about it. But until then, or until Fannie and Freddie give us better advice, these things will continue to be a problem. That includes the fact that banks are charging significantly higher fees for cash out refinances, anywhere from 1 to 5% extra in upfront fees. That means if a homeowner is taking out $300,000 in a cash out refinance, they could be paying as much as $15,000 of extra fees on top of the normal fees in order to do that cash out refi. Now, we're not charging that high of a bump. We did bump our cash out refinance fee by 1%, but that's the lowest of anybody in the industry. Some people are bumping them by as much as 5%. Clearly, we're taking a significantly greater risk in doing a cash out refinance because we could lose a lot of money, and therefore with risk needs to come greater return to offset that. We also have other issues with investment property loans. Summit Funding is not counting rents on any property that does not have a tenant currently in there that is intended to stay. In other words, if you bought a rental property and it is currently owner occupied and the seller is selling the owner occupied property and you're buying it to rent it out, I cannot count rental income from that property to qualify. Only if you're buying a rental property that is currently occupied by a tenant and that tenant intends to stay, then and only then can I count rental income on a purchase transaction. On a refinance, I cannot count rental income if someone is refinancing an investment property that does not have a tenant in there. More importantly, is if someone is buying a new primary home. and they intend to keep their old home as a rental property. We call that the departure residence, and we can normally get an appraiser to give us an average rental income of what that departure residence would rent for, and we can count that as income for their ability to qualify to offset the mortgage payment on the house they're moving out of. We won't count rents on that property because you don't have a tenant in there yet. You're still living there. So that's another challenge when it comes to purchasing homes, that if somebody owns a home and they want to keep it as a rental and buy another home in today's market, they've got to be able to afford to make both payments. And some banks are requiring anywhere from 6 to 24 months of additional reserves on investment property purchases to minimize their risk. All right, I want to move on to some other topics here. So first, some good news, if you want to call it good news, and it's also me eating my words, because I told you guys a few weeks ago, a month ago, 2 months ago, that non-qualified mortgages were gone and they're not coming back. Well, I was wrong. So we have a short memory on bad loans. The good news is that they're coming back in a very, very limited product offering. Angel Oak is one of the biggest investors in non-qualified mortgages. We broker loans to Angel Oak. They've come out and said, we're going to do 2 products. We're going to do jumbo loans, which is actually pretty smart of them, because jumbo loans are a marketplace that has been decimated, and that nobody's really participating in that market right now except for a few large banks with super, super conservative rules. But they said our jumbo loans are going to start at around 6% interest rates. So that's a pretty sizable increase over what the average rate had been on jumbo loans previously. If we continue to see jumbo investors go away, we may only have jumbo options at the 6+% rate. The good news is at least there are jumbo options that are opening up again, but the bad news is they're super, super expensive, and we need to be concerned or at least aware of that fact. The second thing that's coming out back in non-QM is bank statement loans. Now, I guess bank statements are the most conservative method of proving income outside the normal guidelines, because we're seeing your deposits. You can't fake that. We're seeing how much money you've been putting in the bank. Now, up until the meltdown a couple months ago, we had bank statement programs that required as little as 2 or 3 months of bank statements. Well, 2 or 3 months of bank statements, you could easily start depositing a boatload of money for the next 2 or 3 months and then qualify for your mortgage 3 months from now. What they're saying is, no, 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 we're not doing any of that stuff. We're only going to do loans with 24 months of bank statements or more. So you can't do a short amount of bank statements. The other thing is that they're not getting very aggressive in loan to value. You've got to have a 25% down payment and a 760 credit score. If you have less than 760, you can still go down to a 700, but you got to put much more than 25% down. In other words, this isn't a mainstream product. It's a product for a small segment of people that absolutely need to do the loan, and it's a way to get the loan done. But their challenge on top of that is these bank statement loans, they're requiring a 2-year prepayment penalty. So we're seeing a lot of funky things coming back in the market, and I'll continue to update you as I see more and more of this coming back. Again, as a reminder, if you have questions, feel free to post them into the chat. Guys, I'm super worried. I've been telling you over the last couple of weeks, and I'm getting more and more worried about home equity lines of credit getting trimmed. I told you all last week about my jumbo alternative and the fact that we can do a first mortgage conventional and a second mortgage up to 90% of the home value, and that's a great option for replacing jumbo loans. And as a matter of fact, I sold that option more often than I sold jumbo loans. We had 2 banks that we sent them to. We had 2 banks that we would send our home equity lines of credit to. Yesterday morning, one of the banks said no more. They are no longer accepting applications for home equity lines of credit. Yesterday afternoon, the other bank that we work with internally said, well, first of all, what you see here was updated on Monday. I didn't update it completely. So I've got, as of yesterday afternoon, one lender, as of Monday, one lender said, I'll still go to 90%. The other one dropped their loan to value to 85%. This one that dropped their loan to value to 85% on Monday, they stopped accepting applications at all. They've closed. The one that was still going to 90% will still go to 90% loan to value, but they stopped doing refinances. They're focusing only on purchases, which is fine. That's what you guys do, is purchases. They've significantly increased their rates. So the rate on the home equity line of credit a week ago was prime, which is 3.25, plus 1.5%. So it's between 4.25 and 4.75%. They're doing prime plus 3, prime plus 4. We're looking at that second mortgage being at 6 to 7% because there's huge risk now. And that company, thankfully, they're at least still willing to do it. But they've said, hey, if we're going to be one of the last ones doing it, we're charging a whole lot more for it. This market is changing quickly, and you're seeing that. As of last week, Wells stopped accepting home equity line of credit applications. So 2 major banks have stopped accepting applications on home equity lines of credit. A couple of my banks, smaller banks that we have relationships with, are trimming their lines of credit. I expect this trend to continue. I don't yet expect to see them curtailing or reducing the line of credit amount, but that would be the next thing they would start doing. If there's concern that values are going to start dropping, even if they don't see the values dropping, but if there's concern about it, they're going to start limiting the loan to value, start limiting the credit line availability. We saw that back in 2008, 9, and 10, where you had a $100,000 line of credit and you owed $20,000 on it. And overnight, the bank sent you a letter saying, hey, we've lowered your line of credit limit to $20,000, which happens to match exactly what you owed. And then you pay down $10,000 of it, and they say, okay, cool. And they send you another letter saying, we've lowered your line of credit down to $10,000. In other words, whatever you pay, they're going to lower your credit limit because they don't want you being able to borrow any more. That's a major question mark about whether that's going to happen. I have not seen anybody doing that yet. I don't expect that to happen, but expect the unexpected might be the new term. So we'll see where that goes. All right. I want to give a little more clarity on down payment assistance loans and what I got some information from Todd Screama, the owner of our company, last week, and he shared a little bit more about why we lost them and what it's going to take to get them back. And this really helped me understand it better and helped me to explain to you guys better. When we do a down payment assistance loan, nationally, there's only 2 banks that buy what we call them the master servicer. They are the buyers of the mortgage for all down payment assistance loans pretty much nationwide. They're the only 2 companies who do it, and that's US Bank and Lakeview. And they both announced at the same time about 2 months ago when this whole forbearance thing rolled out that, hey, anybody who does down payment assistance, if they go into forbearance before we buy the loan from you, we're not buying the loan at all. Now, that's very similar to what Fannie Mae and Freddie Mac are saying about cash out refinances. But there's a couple of major differences. We can sell a loan to Fannie Mae and Freddie Mac in about 2 weeks. It takes about 2 months to get a loan sold to these master servicers because it has to go through the down payment assistance entity first. Cal HFA or GSFA has to process it. Then we send it to one of these master servicers. They audit all of the loans and then they buy them. It takes upwards of 2 months. And knowing that, almost every mortgage company said, I am not willing to do that because the mortgage, if it's not being bought by one of these master servicers, is literally worthless. When we have a cash out refinance right now that Fannie Mae won't buy, we can still sell it on what's called the scratch and dent market. You've heard me talk about that before. It's kind of like the grocery outlet where the canned foods that get dented go. Same thing for mortgages. There's a scratch and dent market where we might take a 25% haircut. So if we've got a $300,000 mortgage, we might lose $75,000 on it, but at least we get $225,000 back. But these down payment assistance loans, even the scratch and dent market is unwilling to buy them. They are literally worthless. There are 2 banks that we are aware of that Todd was talking about, that he coaches one of them, because as he owns a coaching company, and he also coaches other mortgage banks. And one of them, he had been talking to the owner over the weekend, a week and a half ago. And the conversation came up about down payment assistance loans. And he said, oh my God, Todd, I don't know what's going on, but I have $3 million of down payment assistance loans. And mind you guys, that's 10 loans at $300,000 a piece. It doesn't take much to hit $3 million. He goes, I have $3 million of down payment assistance loans that went into forbearance that I'm being told I have to own them and I can't sell them anywhere. Have you heard about that, Todd? And first of all, Todd said, dude, I told you this a month and a half ago that you need to stop accepting down payment assistance loans because I told you this is exactly what was going to happen. That next Monday morning, a week and a half ago Monday morning, this is a large mortgage bank. They literally cut all of their down payment assistance loans where they stood. In other words, they canceled every single in-process down payment assistance loan that Monday morning. You guys wonder how loans get approved and then in the end the funding gets pulled and they say, nope, I'm not willing to fund it? That's some inside information about how that happened, because that mortgage company wasn't paying attention to the memo that said you're going to own this loan if the buyer goes into forbearance, or didn't understand the consequences of it. But once they were sitting on $3 million of mortgages that they had to own, they immediately said, no more. I'm not funding a single another one of these loans. If you have not closed escrow yet, you're never closing escrow under this program at all until the rules change. Here's the good news. The good news is that Todd's been having conversations with both of these servicers and they're making progress. And we feel like if they can at least give us some clarity like what Fannie Mae gave to say, hey, at least we'll make you take a 7% haircut. Well, at least on a $300,000 loan, we know that it's going to cost us $21,000. We can plan for that. We can say, all right, fine. If that happened, if a home buyer went into forbearance, then the loan officer, I would lose all of my commission. They'd take it straight back from me. The branch and the company would lose all of their income, and Todd would still write a check for a few $1,000s. But at least he can plan for that, and we'd be willing to move forward. We're hopeful that we're going to get that kind of clarity, and if they're willing to at least play ball, then we will open these back up. But that's the major issue, is these two servicers are saying we're not going to buy the mortgage if they go into forbearance, and any mortgage company that's paying attention is unwilling to take that risk. The ones that are still originating down payment assistance loans, I believe, are likely to stop very soon, because right now is when they're getting their buybacks for people that went into forbearance over the last 60 days, and they weren't realizing how deep of a hole they're digging for themselves. So just be clear, CalHFA is still operational. GSFA is still operational. They haven't changed. This issue has to do with our bank and their bank, meaning the originating bank and the ability to sell the loan to the master servicer at the end. All right. Any questions, again, feel free to post them onto the chat. Guys, here's my new news for today. Ha, Penny, perfect timing. This is right where I was going. Here's my new news for today. We lost a loan yesterday. I didn't, but somebody in my branch did. Lost a loan yesterday because a borrower took out one of the SBA loans. So here's where the story came about. It's really about future debt and our inability to predict future debt. It's the same thing as a homeowner who went out and bought a car or had a credit check for buying furniture right before we closed escrow. Like, we're worried about what are your future obligations going to be. Well, the same holds true for your business. If we're aware that your business obligations are going up significantly, we have to take that into account. And what happened the other day, one of my colleagues had to send an updated bank statement, and they sent the companies, the self-employed individuals' bank statement into underwriting. And underwriting saw on there a $10,000 line item that's called EIDG, which is the Emergency Income Disaster Grant. So that first $10,000 that you can get when you apply on sba.gov/disaster, there's two components to that disaster relief loan. One is the advance that comes right away for up to $10,000. You can get $1,000 per employee. The second component is the additional loan that you can get at a super low interest rate that you have to pay back over a long period of time. It's great, great terms, but it's still a loan. And what we learned yesterday was Fannie Mae and Freddie Mac are not buying mortgages if we're aware that somebody is in process of these SBA disaster loans, because they're going to have a future liability that we cannot calculate. And until we know, what we think is once we know how much money they're borrowing and what the repayment terms are, then we can at least count that in their debt. If someone's getting one of the PPP loans and it's forgivable, my bet is we're going to count the payment against you until it's forgiven. because we don't know how you're going to spend the money. You might not spend it in an appropriate way to make it truly be a forgivable loan. So this is a major, major concern that's creating unintended consequences. I got to tell you, I'm worried about it going one step further, because technically we could argue as an industry that the business owner applying for these disaster relief loans are claiming their industry or income has been harmed by the COVID disaster. Well, kind of like a homeowner who says, hey, I'm taking out a forbearance, and it was clear from the beginning that, hey, it's not impacting your credit, but as a mortgage bank, we're worried because you're claiming I can't afford to make my payment, I didn't keep enough money in savings, I'm not in good shape. Well, you're kind of saying the same thing as a business owner if you look at it from that perspective. I'm not saying I agree with any of these perspectives, but I'm not surprised that we are looking at it from that perspective. The first challenge is the unaccounted for liability. How much are they going to have to pay every month going forward? Not for that $10,000 grant, because that money is automatically a grant, but the grant is part of the EIDL, the disaster loan. And until we know how much they're getting in the disaster loan and what the payment is going to be, we denied the customer's mortgage. They were literally ready to close and we were just getting an update at the end, and the mortgage got denied because they were in the process of getting an emergency disaster relief loan. Now that happened on the EIDL, that didn't happen with the PPP, but it wouldn't surprise me if we had knowledge that somebody got PPP money that we're gonna have to count that against their income in order to determine that they have the ability to pay back both the PPP money. Even though it's supposed to be forgivable, the fact is until it's forgiven, you could spend the money on whatever you wanted. Guys, significant unintended consequences. We already covered Jeff's part. Significant unintended consequences that are continuing to come up as we peel back the onion. I am concerned about what the market's going to look like and how many more little roadblocks and speed bumps we're going to run into as we reopen the economy, as we start looking at, hey, we didn't think about that, and when this happened, it caused that problem, and that's going to harm our ability to qualify somebody for a mortgage. A lot of questions, not so many answers for you today, but as I promised, I want to keep you guys updated on everything that I know as I know it. So I really appreciate you coming. If you have any questions, post them in the chat. Otherwise, I'll wrap it up simply by saying, please continue to share this information. It's on YouTube, it's on Facebook. If you know anybody who you think should come to this weekly event, send them the link rsvpwithjohn.com, rsvpwithjohn.com. And realtors and business people want to come get this information, I'd love to have you here. Other than that, guys, have an absolutely amazing day. I am off to my virtual summit for training. So every 6 months I go to a 2.5-day event. This year it is a virtual event. So it starts in a couple hours. So I will see you all. I'll be out of operation for the next 2.5 days. My team will take great care of you. I will talk to you all on Monday. If you have any questions about anything, feel free to reach out. Have an amazing day, and we'll talk to y'all soon. Bye-bye.